awesome Mr. Michael Brown, who has just joined. Also, morning, Zach. I apologise I didn't reply to your WhatsApp, but I'm just feeling a bit shit this morning. Invite the co-host. Let's do that. Right, that should be on its way to you. Morning, Tom. Oh, Tom, am I still seeing you for a beer tomorrow?
Good morning, Ryan. Good morning, everyone.
Where's Mr. Brown?
I'm
Here he
here.
is. Good morning. Good morning.
Hello, mate. How you doing?
Do you know what? I've not slept at all well this week, and it's really starting to get on top of me, and I'm feeling very, very sorry for myself and very, very tired. But enough about me. Time to crack on with the legals. Nothing discussed on this basis session constitutes trade or investment advice or infers any kind of endorsement by PIQ Global Limited, traders PIQ or PIQ Suite, or indeed the affiliates, which, as you know by now, is Mr. Michael Brown, way, Mr. Ryan Paisley, way.
Deary me.
Yeah. What's been occurring
Yes, indeed.
apart from
Right.
Rachel Reeves getting a massive bailout thanks to
Well,
CPI?
yeah, quite. The Chancellor lives to fight another day. I actually start this morning with an apology for a slanderous
Oh,
accusation I made yesterday,
oh,
which was that our mutual friend Zach was slacking and he was on holiday. It turns out he's actually in Thailand working. So
I
fair
did
play to
mention
him.
that.
Did you?
Yeah. Well,
I
he
thought you
says
said he was on
work.
a beach.
Yeah, but he's covering the European night shift by being in a different time zone, basically. So he's worked it very, very well, bless him.
He has, but yes, Zach is not slacking.
If
He is
Zach's
actually working hard.
if Zach's employers are listening, he's doing a stellar job. He's not going out at all. He's not seeing any of those lady boys. He's knuckled down.
I heard he'd become one actually, but that's another matter.
Oh,
Right.
God, move on quick, moving on, moving
Yeah,
on.
yes, let's move on. We'll get to those CPI numbers that Ryan alluded to momentarily, but first, just to have a quick look back at yesterday. It was a very, very choppy day, actually, on Wall Street, and what were very modest daily changes, with the S&P closing a tenth of 1% higher and the Nasdaq closing a tenth of 1% lower, masked some fairly significant intraday volatility. At the highs, both indices were up by around about 7 or 8 tenths of 1%, and at the lows, both of those indices were down by around about 1%. So very, very wide intraday range in which we traded yesterday. And this came not only as markets were sort of buffeted by a barrage of external catalysts and news flow, but also amid a continued lack of conviction among market participants ahead of a key slate, or a busy slate, I should say, of risk events coming up, including US CPI a little bit later on today. Of course, the start of fourth quarter earnings season looming large. And last but by no means least, Inauguration Day next Monday. Nevertheless, in terms of those factors moving markets yesterday, the first was obviously those reports that we covered yesterday morning around the potential for Trump to be bringing in tariffs over a more phased and gradual approach than had previously been expected. Obviously, most market participants thinking tariffs, they all come in one go. There were reports yesterday that may not, in fact, be the case. Obviously, a bit of a negotiating tactic from Trump, but at the margin, that would potentially reduce a degree of upside inflation and downside growth risks that those trade policies could prevent. The rally on the back of that news fizzled out as the morning session progressed, but then equities got a bit more of a fillip after a much cooler than expected PPI print out of the United States. Headline PPI rising by 3.3% on an annual basis in December, considerably below the 3.5% consensus, but above the 3% print that we saw in November. Before anyone, excuse me, gets too excited about potential dovish policy implications of that number, it's worth noting that the components of PPI that feed into PCE, forgive all the acronyms here, of course, PCE being the Fed's preferred inflation gauge, the components of the data set that feed into that number were actually relatively hot. So it certainly doesn't lead to expectations for a massively cool PPI number when that comes out. But nevertheless, we did see treasuries advance just a touch, led by the front end of the curve, and the dollar also trading marginally softer, down by about 0.3% when you look at the dollar index, as a result of what was a very marginal dovish repricing after of Fed expectations, I should say, after that PPI print and the dollar index languishing around the 109 figure overnight. In terms of other bits and bobs from yesterday and from early this morning, news flow, a few things things worth noting just in terms of the tech sector. Meta, they are planning to cut the lowest 5% of their performers on an annual basis, and they actually think they're going to lose 10% of headcount by the end of this performance cycle. I think what's happened there is they've spoken to someone who used to work in an investment bank, because this sort of thing has been common in the financial sector for quite some time now. Also on the tech/chip front, one for Tom Talks Cars. Well, firstly, Nvidia have fallen off a cliff recently. They're down by about 12% over the last 5 trading days. Secondly, the US news broke overnight that they are looking to push and persuade both TSMC and Samsung to restrict the flow of their chips into China. Of course, as with most of these headlines at the moment, it's worth caveating that is the current US administration doing that, not the incoming US administration. So, that one could change in relatively short order. And then, of course, just to cover what Ryan alluded to a short while ago, we did have inflation figures out of the UK this morning, which no one will be happier with this data than Chancellor Rachel Reeves. Headline CPI rising by 2.5% on an annual basis in December. That was down from the 2.6% that we saw in November, and also marginally below market expectations, although it is worth noting that that 2.5% figure was in line with the BOE's forecast that they outlined in the November monetary policy report. In terms of the underlying price metrics, some degree of signs that price pressures may be fading there. Core CPI rising 3.2% on the year, down from a prior 3.5% and the slowest pace of increase since September of last year. And the services CPI metric, that rose 4.4% on an annual basis, down from the prior 5%. That's the slowest pace of increase since March of 2022, and also below the BOE's forecast for services CPI to have been at 4.7%. A couple of caveats to that, though. Firstly, a lot of it looks like it could be temporary. The ONS, and this is a little bit technical, so forgive me, but I think it is important. The ONS collected all of the data on December the 10th. That means that a lot of the prices that tend to rise over the school holiday period and also over the Christmas period, if you think about things like accommodation, transport, airfares, etc., those price rises will not have been accounted for in the December inflation print. The survey date for the December 2023 inflation number was about a week later, so it did account for those impacts, which caused something of a favourable base effect, which has somewhat flattered the inflation data this morning. Nevertheless, the market has repriced its expectations for BOE policy in a dovish direction since the data came out. We now see the OAS curve discounting around a 4 in 5 chance of a 25 basis point cut at the next BOE meeting on the 6th of February. That's up for about a 7 in 10 chance yesterday. We also see the market pricing a total of about 51 basis points worth of cuts by year end. That was at about 28, 29 basis points yesterday. And unsurprisingly, gilts have also rallied at the open, with 10 and 30-year yields down by about 7 basis points apiece when I left the desk 10 minutes or so ago. Although it is worth noting, just lastly, before I give it back to you, Ryan, although gilts have rallied, clearly the UK economy is still very, very far from being out of the woods. One cool inflation print does not change the fact that we have no growth and that borrowing is ballooning effectively. And also, even if gilts just stayed here, we're still breaking, or well, Rachel Reeves is still breaking her own fiscal rules. So, put the cork back in the champagne bottle, I think is the message there.
I haven't not had time to look at gilt charts this morning. Curse me. But I'm assuming there's a gap, right? It didn't trade down. It didn't trade.
No, we just gap lower, yeah.
Yeah. So I guess the question is, how long until we close the gap? Is where I'm going with this one.
Yes, indeed.
It'll be a matter of when, not if, in my opinion.
Well, you believe so, and again, you question, you see a move like that. How much of that is just shorts unwinding their positions, and how much of that is actually fresh money coming into the market? And of course,
no real money is going to come in after this figure and think, oh, everything's fixed.
Yeah, exactly that. So don't get too excited just yet.
Exactly. Cool. Well, thank you for that, Mr. Brown. So a few headlines from our friend Zach, and also from a couple picked out whilst Michael's talking from our other friend Andrew, who's also listening. Hi, Andrew. Starting off with some headlines via Zach from the overnight news roundup that we do. So in macro space, Japanese manufacturers' sentiment recovered in January. That's after a dip last month, thanks to better conditions for material industries. But their outlook remains flat due to uncertainty over the proposed Trump policies. That's according to the Reuters Tankan poll. Sticking with Japan, Japan Finance Minister Kato reiterated that the government would take appropriate action against excessive movement on foreign exchange markets. We all know that by now. Over in China, China's central bank pumped a near historic amount of short-term funds into the financial system on Wednesday, dialing up liquidity support amid a cash squeeze with the New Year holiday looming. Chinese regulatory authorities will take multiple measures to jointly build a mechanism for stabilizing the stock market. That's according to the Chinese Securities Journal, reporting by citing some strategists in the CSJ. Investors have poured a record amount of money into equal weighted S&P 500 in the second half of 2024. This according to data from Morningstar. Comes as investors are hedging themselves against the dominance of big tech. Economists say the devastating fires in Los Angeles area are likely to put modest pressure on US economy in the near term, but unlikely to derail a strong forward momentum. Moving over to the UK, 2/3 of UK retailers will raise prices this year. There goes your reduction in inflation. In response to higher employer social security costs. That's called.
Who the
According to
hell's
the
written that?
CRC.
That's called national insurance. Is that some yank
Yeah,
journalist
I
that's put
was
that
about
together?
to read out just national insurance. I thought, what the hell is this again? And I didn't have the mental capacity to kind of just override it. So apologies for that. Yeah, but again, this is something we know is coming. It's going to be, I think, 2025. It's gonna take pretty much the whole year to shake this out, in my opinion. And of course, then we've got the chance of emergency budgets and that coming in as well. So, ugh. But anyway, we could have a whole show on this in the UK at the moment, unfortunately. Anyway, where was I? Energy producers have rushed to lock in oil prices since the US announced its harshest sanctions yet on Russian energy trade on Friday, which sent oil prices surging to multi-month highs. That's according to market participants and traders. On this, more than 2 million WTI light sweet crude oil futures traded on both Friday and Monday on the CME. Our friends at the CME, name drop them. The first time volumes have exceeded 2 million since February and March in 2022. So that market is livening up like no end. Saudi Aramco is expected to expand its investment in lithium production in a race to build supply chain for the metal vital for batteries to power obviously the EV shift and all of that stuff. So the oil giant is increasing its move into the EV to become an EV giant, well, an EV metals producer giant. Geopolitical news. Iranian vice president said Iran discovered Israel's planting of explosives inside its nuclear uranium centrifuges. That's according to a translation of an Al Arabia post on X. That's via our friends at News Corp. Just on this, if you haven't seen it already, I really do recommend you watch the documentary Stuxnet. It's a little bit old now, but it's about a computer virus that the Israelis put into the centrifugal area, like operations factories and stuff. It's very, very good. It's a documentary. It's all true, and it's quite scary. Anyway, Ukraine's national grid operator has introduced emergency power cut, in 6 regions amid massive Russian missile strike. In equity names, reports in Korean press say that this is obviously for Thomas Talks Cars, that Nvidia's next-gen Rubin chip could launch in late 2024, earlier than anticipated. On this as well, I know. Go on.
Well, I may be about to steal your thunder, so go on, and then I'll say what I was going to say.
Okay. On this, they also did come out and say that the delays that we're seeing on the other chip, that was it, the GB200, I'm guessing what this means, is complete rubbish. So yeah, they're pushing back on. Yeah, we all love a good pushback story. They're pushing back on reports of these delayed chips. Sorry, what were you going to say?
Well, I was going to say now we all know that I'm an expert on technology and chips and all the rest of it. But well, indeed, I was talking to our good friend Tom Talks Cars yesterday, and he was saying it reminded me because you said that this thing might be coming earlier than expected. Apparently, according to his sources in the technology sector, Nvidia have actually persuade quite a lot of people because they keep releasing new products very, very shortly after they've released. You throw out a new fancy bit of computing equipment, and it's the best thing since sliced bread. And then 3 months later, you've got another new fancy bit of computing equipment, which is 10 times better than the last one, and even better than sliced bread. And actually, the word on the
What's
street,
better
so
than
to
sliced
speak.
bread?
Well, apparently the word is that what's happening here is actually you're finding people are quite reluctant to place orders with them because they're
Ah, I
worried that they're
see.
just going to end up getting burnt. Because it's like if, for example, I go out to PC World or Curry's now and buy a laptop, and then
Hi, Commodore
you know
64.
well, exactly. And then, in a week's time, Dell have released a brand new one. I'm going to be pissed off and go in and say, why didn't you tell me that? And I think that's just happening on a broader level, as so I understand.
Well, look, and then Tom is our man on the ground. You'll be down in Shoreditch drinking mango cider with him next.
Oh,
God, heaven
God.
forbid. Anyway, where was I? Elon Musk. There we go. Our mighty leader. He's been sued by the SEC, which accused the richest person on Earth of waiting too long to disclose his 2022 the amount of Twitter stake he was holding. ExxonMobil, they've discovered a natural gas depository, or nearly said suppository, off the coast of Egypt after successfully drilling an exploration well in the Mediterranean Sea. So that's a boon for them. Regarding the LA wildfires, it's been estimated that the cost of losses to the insurance industry is now as high as 40 billion. Now, bear in mind that this is just the cost of the insurance companies. We've already had stats out. We posted some on VIQ actually 2 days ago, where at the time the insurance costs were like anywhere between 10 and 30, but the cost to just people in general, obviously this includes uninsured losses, was anywhere from 175 to 275 billion, because there's so much in LA that's not insured for this, because the insurance companies were forced to pull back their protection due to some measures brought in by the government, and kind of it made the insurance untenable over there. So if they're saying that the losses could be seen as high as 40 billion, I dread to think what the total economic cost will be. So I want to keep an eye on for that and looking for any insights we get from that and see what knock on it has for the Canadian, well, so the Californian economy, which, as we know, is quite a big one. Finally, on equity names, Nippon still remains interested in working with the incoming administration. Obviously, that's Trump to seal the takeover of US Steel. That comes as we've seen that it's all getting a bit tasty over there at the moment. And finally, just a couple of headlines from our good friend Andrew. Some kind of tidbits that I've pulled out of his note that are quite interesting. Secretary of State in his confirmation hearing, Rubio claimed that will claim that China cheated, hacked, and stole its way to a superpower status. As Andrew rightly puts, diplomacy looks alive and well there. So we'll wonder how that goes on, or goes down with the Chinese. Iron ore shipments from Australia's top terminal reached a record in 2024, and that's even though China has been in the throes of a steel output slowdown. So there are some good signs on the commodity front that perhaps there are other buyers of interest out there. Volkswagen has had a poor 2024. We all know that, with sales falling, and Europe's biggest automaker even raising the prospect of closing factories in Germany. This year could be even worse, with the automakers brand is struggling in US and China because of patchy offerings. That's according to Bloomberg. So more nails in a coffin that is primarily nails at this rate. And finally, from our good friend Andrew, in US gasoline futures, they rose to the highest since October. Yesterday, that was as the Colonial Pipeline shut. That's the largest US fuel pipeline after they need to investigate a potential leak in Georgia. And that's it from me. Back to you in studio.
Good stuff. Thank you, Ryan. Well, in terms of the day ahead, of course, all eyes will be on the US CPI figures that we have out at 1:30 this afternoon. But before we get to that, we do have just one release from the Eurozone this morning, and that is the November industrial production figures, where production is seen rising by 0.2% on a month-on-month basis compared to the stagnation that we saw in October. Naturally, though, that will be massively overshadowed by the inflation data that we have out of the US this afternoon, of course, due at 1:30 London time. Headline CPI seen rising by 2.9% on an annual basis in December, an uptick from the 2.7% pace that we saw in November, while core CPI is set to hold steady at 3.3%. It seems highly unlikely that the data is going to significantly move the needle for the FOMC, at least in terms of the January meeting, particularly after the blowout jobs report that we had referencing December on Friday. Nevertheless, it must be said that bond bears are going to need little reason to reassert their control over the market and resume selling pressure at present, particularly if we were to get a hotter than expected inflation figure, say headline CPI rising north of 3%. I think what was interesting, though, about the reaction to the jobs number that we saw on Friday afternoon here in London was that actually the equity market and risk assets in general seem to have a renewed focus on the policy path as opposed to being focused on the idea of the economy remaining strong and that underpinning earnings growth in turn. What on earth is going on there?
Yeah, that wasn't me. That was someone with a little motorbike going past, by the sounds of it.
Oh, right. Fair enough. In any case, yes, as I was saying, so equities, you would expect some fairly chunky selling to come in the event of a hotter than expected number. As I said, and also you'd expect bond bears to reassert control relatively rapidly. Just to frame market pricing around the FOMC at the moment, the market pricing absolutely nothing for the Fed in January and not fully pricing a 25 basis point cut until September, while pricing a total of just 29 basis points worth of easing by the end of this year. Of course, do bear in mind as well that the CPI number, and I know I keep harping on about this, is coming, effectively 3.5 trading days ahead of President Trump being inaugurated. And as a result of that, you are likely to see conviction remaining relatively low across the board, no matter what the data says later on. In terms of other bits and bobs to keep an eye on today, we do have a fair bit actually to digest in terms of monetary policy. We are due to hear from the Fed's Goolsbee, Williams, Kashkari and Barkin as the day progresses, while remarks from the ECB's De Guindos, Villeroy and Vujic are also due, as well as comments from the BOE's external member Alan Taylor a little bit later on today. Taylor, bear in mind, that will be his first, I believe, his first speech as an MPC member, and of course he did vote in favour of a 25 basis point cut at the December MPC. He was in the minority of three that voted for that action. We also today have the release of the Fed's beige book of anecdotal economic evidence. And last but by no means least, today marks the official start of fourth quarter earnings season on Wall Street. Before the opening bell, before the opening bell, we are due to have reports from JP Morgan, Citi, Wells Fargo and Goldman Sachs, among others. And that comes ahead of Morgan Stanley and Bank of America wrapping up bank earnings before the open tomorrow. And that's your lot from me this morning.
I would like to see you rap. I think I might get you to do that after a couple of pints.
I need more than a couple of pints, I
think. Okay, a couple of shandies. Right, Michael Brown, thank you as always. I could do with going back to bed, to be honest. I haven't slept at all well, but unfortunately, PIQ demands that I'm around. Making everything better. So if you haven't checked out PIQ, please do. We've also, I can't remember if I mentioned this today. I definitely mentioned it yesterday, but now we have about 400 new sources of content on the platform. So please do check it out. And there's lots more to come as well. And if you speak to me nicely and drop me a DM, I'm probably likely to give you a significant discount or even some free months to give it a go. So do that, see what happens. Hope you like it. But Mr. Michael Brown, thank you as always. Listeners, thank you. And we will see you all tomorrow.
Indeed we will. Bye for now.
Bye for now.